Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. Here's your weekly technical analysis of Chicago wheat and corn. I'll start with Chicago wheat. 10 weeks ago we saw the top of the recent market capped by the upper time, currently 801, of the March to July bullish shift pitchfork. Now this is a shallowly bullish pitchfork, but one should not underestimate its power. Anyway, prices started a stuttering move lower, down through the middle time, currently 715 of the same pitchfork, as well as the short medium moving average, currently 735, and the medium moving average, currently 709. These supports did not stop the decline, and prices then challenged the important January 2021 high at 693 and the 50% Fibonacci line of the whole of the 2021 action at 689. Both these also buckled, but by now all these broken supports had eroded enough of the bearish incentive that when prices approach the next level of supports below all of the previously mentioned levels, these were the important 50% absolute Fibonacci line at 675 and the 50% Fibonacci line of the big old 2012-2015 move at 670, along with the slowly rising long moving average, currently 687. Well, these supports were better able to deflect the bearish incentive. It was enough of a deflection that they were not even tested, and prices started rising back up again 5 weeks ago. A few things happen now in this rise. The most obvious was the creation of a complex series of reverse head and shoulders patterns over the mid-August to end of September period. You can see the limited neckline on the daily chart, and I've not labelled any targets as they had already been achieved. I regret to say that I only really saw these patterns in hindsight. Meanwhile, last week I drew a new bullish shift pitchfork for the July to September move, as the market seems to be travelling higher in between the lower time, currently 724, and the middle time, currently 794. We also had some support emerging from the gently rising short medium moving average, that's currently at 735, but on a closing basis, though most of this past week we've seen the short moving average currently at 750, paralleling along the lows of this week. Okay, as I've said these past 2 weeks, and I repeat it here, I know that this is a lot to get hold of. So please feel free to rewind and play this bit of the recording again, and you'll see that what I've said does make sense. Additionally, as I detailed last week, immediate topside resistance, well, that seems likely to be in the area around the April, May and recent October highs, roughly 770 up to 776. Finally, though this week has been an overall bullish week, we've seen some contradictory patterns appear on an intraday basis. This may suggest that as we approach the recent highs, from what was effectively a small V bottom, we may see a reluctance to push that much higher. Hence, I would suggest looking at the overhead tines as potential rejection points, at least initially. Overall, caution. Chicago corn. As I mentioned here the last 3 weeks, the most important feature to consider in recent days was the move down below the long moving average, currently 562, especially the second time done 7 weeks ago. This proper break below the long moving average hadn't happened, well, since really November 2019. The questions I posed for the last 4, now 5 times were, would the market exploit this move lower, and if it did, which pattern would it choose? Well, the first bit was easy. And was done with some style 7 weeks ago with a weekly key reversal down. However, prices hesitated around the key combination of the 61.8% absolute Fibonacci line at 525, which is actually also the 2014 high. Eventually, prices did push below this key support combination with the aid of the now 2 main patterns. They are a sideways triangle and a descending triangle. The sideways triangle was formed on the top side by the now 3-pointer downtrend, currently at 540, originating from the start of April, and below by the broken, indeed well broken, July to September uptrend, with the aid at the time of the its now departing partner, the long moving average. And this had a potential target in X in the 509 area, which was achieved 6 weeks ago. Meanwhile, the descending triangle utilizes the same June to date downtrend on the top side, but then the flat base of the previously mentioned key combination of the 61.8% absolute Fibonacci line at 525 and the 2014 high at the same level. This now has initial target X below in the 475 area, with a secondary target X2 in the 425 area. and that last one is right on the 50% absolute Fibonacci line. So far all well and good. However, the market had some other ideas, and over the past 3 weeks or so, prices have fallen, but primarily risen enough that we've not only moved up back over the 61.8% Fibonacci congestion and all the way up to almost touching the rising long moving average, but this week we've pushed up through the downtrend. So what does this mean now? Well, an obvious observation would be that the drop down at the start of September was a false break lower, and I can see the merit of that. However, just be aware, these markets, like life, are usually a lot more complicated than that, and I think this may be the case here. You see, the recent move back up seems to have been a disguised period of indecision, as I'd previously pointed out. What I can say is this: the downtrend has squished this market between the 525 level and a declining downtrend, so a break of something was going to happen, and right now it looks like it's been a break of the downtrend. And it may have just done that. Hence what I have said here now for the last 3 weeks, namely, and I quote, I am also quite happy to start targeting the top side as well, but only on a confirmed break higher. Keep an eye on this. So, though it is not fully confirmed on the upside here yet, there are nevertheless some targets on the upside. Initial target X3 would be in the 605 area, whilst the secondary target X4 would be in the 641 area. Please also note that by the second week of November, the market will have reached the apex of both triangles. Now, there is one other option, something I discussed last week, that had made seemingly itself available, is to look at the July to date action as a possible descending wedge pattern. This links the lower trend line well below the market, currently at 482, with the original early July 3-pointer downtrend. However, as we're now seemingly exiting up through this very downtrend, then I think the points of this pattern may be moot. Thus, I will leave it on for one more week at least, just in case, but I suspect this idea will be retired. It all now depends on what the market does over the downtrend, and the first resistances are not too far away. They are the slowly descending medium moving average, currently at 553, and the slowly rising long moving average, currently 562. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Tofpik and ADM Investor Services International Limited. And here comes the final bit.